Norway did not become rich by drilling oil alone. Oil created capital, but investing created wealth. Today, Norway owns small pieces of nearly 9,000 companies across more than 70 countries. It owns part of Apple, part of Microsoft, part of Amazon, part of thousands of global brands. It quietly owns about 1.5% of every publicly traded company on Earth. And yet, most people never notice. This is the story of how Norway became a silent owner of the world. When Norway created the government pension fund Global, it faced a critical question. Where should the money go? Invest domestically? Build local mega projects? Buy national champions? Norway chose something radical. It invested outside Norway, almost entirely. Why? Because investing oil money at home would distort the economy. Too much capital would. Overinflate property markets. Overstrengthen the currency. Undermine exports. By sending oil revenue abroad, Norway protected its own economy from overheating. Oil wealth would not suffocate other industries. It would grow elsewhere. Norway's fund managers made another unusual choice. They did not try to beat the market. They did not gamble on trends. They did not chase hot stocks. Instead, they followed a largely passive investment strategy. They bought broad market indexes. Thousands of companies, small stakes, diversified globally. Why? Because over long periods, global markets rise, and costs matter. Passive investing reduces fees, reduces risk, and compounds quietly. While others tried to outsmart the market, Norway simply owned it. The fund invested in North America, Europe, Asia emerging markets. It allocated capital across equities, bonds, real estate infrastructure. This meant one simple thing. If one country slowed down, another might rise. If one industry fell, another might grow. Oil prices could collapse, and the fund would still earn returns. This was crucial. Norway was transforming a single volatile commodity into a globally diversified financial engine. The fund did not only pursue profit, it adopted ethical guidelines. It excluded companies involved in severe environmental damage, human rights violations, corruption, certain weapons production. This was not just moral positioning, it was risk management. Companies that destroy environments or violate laws face long-term instability. Norway's fund invested with a generational mindset. Quarterly gains did not matter. Decades mattered. Here is where the story becomes extraordinary. More than half of the fund's $2 trillion value did not come from oil deposits. It came from investment returns. Compounding did the heavy lifting. When returns are reinvested year after year, growth accelerates. This is mathematics, not magic. Small returns, repeated consistently, over decades. Oil built the seed. Investing built the forest. Today, Norway earns more from its global investments than from selling oil and gas. That changes everything. It means Norway's prosperity is no longer dependent on drilling. It means when oil production declines, income continues. It means the country transitioned from a resource economy to a capital economy. This is the ultimate transformation. Norway does not need oil prices to rise tomorrow. Its wealth now lives in technology companies, global infrastructure, real estate worldwide, international markets. The country that once depended on a single resource now quietly participates in the entire global economy. In the next episode, we explore something even more difficult than building wealth: protecting it from politics. Because the greatest threat to long-term wealth is short-term power.